Okay, welcome to the section where we'll continue our discussion on income taxes. Okay, the last time we held the class virtually, we discussed extensively on the income tax with respect to current taxes. And if I could refresh your memories, I'll share this slide and where we came out with this template at that point in time, if you could recall, we came out with these templates, and if I could enlarge it, we came out with something like this. Where we talk about current tax being the actual tax payable to the tax authorities based on current period performance of an enterprise or an entity or a company, as the case may be. Okay, and there we talked about how do we have taxes. We said it is triggered and influenced by the relevant tax laws. Okay, and in Nigerian context, for a company, is triggered by the Company Income Tax Act, Cap C21, Laws of the Federation of Nigeria. Okay, and if it's for petroleum, oil and gas upstream entity, it's also supported by the Petroleum Profit Tax Act, which will now be replaced with the Petroleum Industry Act, okay, of 2021. But that is that, okay? And this is how, in line with CETA, how current tax is being ascertained. Okay, company income tax you compute in line with CETA or PPT, petroleum profit tax you compute in line with PPTA is what we consider as current taxes for financial reporting purposes, which is IFRS 2. And that's IAS 12, sorry. Okay, now in this computation, what we arrived at then, if you could recall, is that we started with accounting profits. We made relevant tax adjustment under 4 headings. Okay, what are the headings? We have non-allowable expenses, non-taxable income, nominated allowable expenses, and nominated taxable income. And on that premise, we arrive at our profit adjusted for tax purposes, otherwise known as accessible profit or adjusted profit. We went further to look at loss reliefs and as a deduction, and capital allowance as a deduction. Okay, we went further to determine our total profit or what we call taxable profit. And on that premise, we computed our estimated current taxes, which is made up of the following. The combination of these, depending on the industry you belong to. Okay, company income tax at 30% of taxable profit, tertiary education tax of 2% on accessible profit, information technology development levy, 1% based on accounting profit, and capital gain tax, which is based on 10% of any chargeable gain in any fiscal period. And that's how we arrive at this. We also went further to discussing issues that borders on certain tax positions, okay, which we discussed earlier. And how do you arrive at chargeable gain is comparing your sales proceeds from disposal of qualifying assets or chargeable assets against the cost of that asset, including incidental costs of lifting the asset prior to its sale. And that's how we arrive at chargeable gain that we used in this course of doing this illustration, building this model. Okay, now let's leave this and let's go back to why we are here today. We are here today to discuss the continuation of income tax, especially with respect to deferred tax. Okay, what then is deferred tax? We need to go back to the start of our discussion. Okay, if you remember, we said income taxes comprises of current tax or current taxes and deferred tax, okay? And deferred tax, as we all see from the preliminary discussion I had then, was that we see it as an adjustment to current tax And the question then is, what brings about that adjustment? Why are you making that adjustment? Those are the things we need to have discussion on. Now, I'll try to share my whiteboard with you guys with respect to where we stopped in the last section. Okay. Where's my board? Okay, I think this is my board. If I get it right, okay. This is how we started that particular day. Okay, we started with tax. What is tax? What is taxation? And we went on and on and on and on and on and on until we more or less finish all the perspective with respect to current taxes. Okay, now this is where we stopped the other day. Yeah, and that's where we'll continue from. Now, before we start our discussion on deferred tax, is there any commentary expectation that you have so that I can incorporate that in the whole of this discussion as time goes on? I can't see any hand. Okay. If you want to contribute, kindly signify the show of hands. Sorry, what's happening? Okay. Okay. There's none. Let's start from where we stopped. Now, I'll put something forward first. And I don't think I put it forward before now, but let me just put it forward first, and we'll move on from there. Deferred tax. Now, when we talk about deferred tax, you must bear the following in mind. Number one, that deferred tax is not a tax. And by the time we reach conclusion, you have better appreciation of why is it not a tax. But if it's not a tax, and let us assume we accepted this notion, what then is it? It is a mere accounting measure. The question then is, what do we mean by an accounting measure? An accounting measure is otherwise known as a form of estimate that is made solely for a purpose. The question then is, what is the purpose to which this estimate was made? The purpose is to serve as an adjustment to current taxes. The next question we ask ourselves is, why are we making an adjustment to current taxes, which we've done in line with the requirement of the relevant tax laws? Is that we are making this adjustment in order to reflect the future tax consequences of the current period transactions and events. Therefore, since at the preliminary stage, we assume or we accept, rightly or wrongly, that deferred tax is not a tax. And rightly or wrongly also we said it's not a tax because we take it as a mere accounting measure, a mere accounting estimate that will serve as an adjustment to our current taxes. And the reason why we are reflecting this adjustment in the books is to capture what may have been left out by the current tax computation in accordance with the law, which may not be in tandem with the economic substance of those transactions as event as reported for financial reporting purposes, therefore creating future tax consequences, be it a form of tax savings or be it a form of additional taxes arising from what has happened in the current period. And this is what culminates to what we might consider as deferred tax. As I said earlier, if you go back up to where we started from, we said deferred tax is an adjustment. And an adjustment could be positive, could be what? Negative, as we identified here. When it is positive, in this case, it's like increasing the amount of current tax, adjusting current tax upward. When it is negative, it's like adjusting current tax downward, which means we are now looking at the form. This is the legal form of our tax. Why what we report in the financial statement is the economic substance of our tax. What we pay as taxes is the legal form. What we report is the economic substance. The difference between the two is the deferred tax. And that's why we say deferred tax is not tax. And we're going to see why is it not tax, because over time, during the life of the business, the legal form and the economic substance will converge, all things being equal, which means there should be convergence, which means the difference between them is more or less of timing of recognition, which we call timing difference. And as time goes on into the future, in the life of a business or in its life cycle, the timing difference will zeroize, will become zero, such that the legal form of tax is paid over time, and the economic substance of taxes as being reported will be the same in effect. We are going to see that today. Okay, and that is that. And that brings us to the following. To say, okay, is deferred tax a tax? In answering the question, by the time we go through these subordinated questions, we'll be able to reach conclusion and either accept this notion or reject it as a form of hypothesis. Okay, now, in order to expatiate our cost and knowledge of this, the following questions is given birth to. The first aspect of the question is that deferred tax from our assessment emanates from the fact that there is a temporary difference. The question then is, what are temporary differences? Two, from this diagram, we discover that temporary difference can take two sides. Temporary difference could be taxable and could be deductible. The question then is, at what point can we conclude that temporary difference is taxable? At what point can we conclude that temporary difference is deductible? The next question is this. Taxable temporary difference, though give us deferred tax, but it gives rise to deferred tax from the liability perspective. Whereas deductible temporary difference does give rise to deferred tax from the asset perspective. The question then is, how do we determine deferred tax liability as opposed to deferred tax assets? And what role does tax rate plays in determining that? We may be confronted with different tax rates based on tax regimes or based on changes in individual tax regimes. Therefore, what rate of tax or what rates of tax is or are applicable at any point in time? These questions, our ability to answering them will give us a sense of understanding and appreciation of what deferred tax is. Now, let's go further. In answering the question, I'll take us back to our slide. Now, what is deferred tax? As you can see, deferred tax is an accounting measure used to match the tax effect of transactions with the accounting impact and thereby produce less distorted results. As I said earlier, accounting under IFRS is much more a reflection of the substance of transactions rather than the legal form. Now, the current tax as computed with relevance to tax law is not necessarily in alignment with our financial reporting standards, which gave rise to the recognition of those transactions for financial reporting purposes, thereby creating a gap. In the legal framework, we call it a lacuna. And this gives rise to different recognition or different measurements and in time to which the same transaction is reported for tax purpose and is reported for financial reporting purpose. In that light, what then happens is for us to identify what we need to do. And what we need to do is first of all to appreciate that there must be something that serves as a source or cause of that difference. And that item is what we call temporary difference. Temporary difference will be viewed from the balance sheet approach, which says that it's a difference that emanates between the carrying amount to which an asset is recognized or a liability is recognized for accounting purposes, and the tax base of such an asset and liabilities, which is also the amount in which that particular asset or liability is recognized for tax purposes. Which means we are looking at balance sheet values one after the other and making comparison between what you have recognized them for by way of IFRS requirements and what you should have recognized them for where you are to strictly apply the relevant provision of various tax laws. In this context, we are looking at Nigerian tax law. And that is what brings about temporary difference. And what temporary means that this difference is by way of timing. As time passes, the difference will wipe out. Such a difference will no longer exist. And that is what it means by that. Okay. Furthermore, we need to now ask, temporary difference could be taxable. Temporary difference could be deductible. The question then is, when is temporary difference taxable? When is temporary difference what? Deductible. Temporary difference is taxable if the differences in recognizing an asset or liability were such that it will give rise to an entity paying more taxes in the future rather than paying lower taxes in the future. Such a difference will have given you aid today to reduce your today's tax at the expense of increasing your tomorrow's tax. Such a difference that creates such a situation of potentially increasing your future taxes as a result of event that has occurred today with respect to such recognition will give rise to what we call a taxable temporary difference. Conversely, if such a difference is that it gives you a benefit of reduced taxes in the future, probably because in today it has exposed you to higher taxes, such an event will be characterized as giving rise to a deductible temporary difference, which means deductible temporary difference will lead to a reduced taxes in the future, while taxable temporary difference will lead to more or higher taxes in the future, given that your tax rates remain the same. And that is what we need to take into consideration. Any question at this point, you can raise up your hand if you have the need to do that. Okay. Now, the next question then is this. How do you determine our deferred tax assets and our deferred tax liability? I'll take you back here. Deferred tax liability. DTL is determined with reference to the tax rate that is applicable. We multiply it with the taxable temporary difference. The result here is your deferred tax liability. Conversely, our deferred tax assets, DTA, is our tax rate multiplied by the deductible temporary difference. But it doesn't stop there. Plus in situation where we have unutilized tax losses that is allowed to be carried forward, it's going to give rise to a reduced tax in the future if you go by our computation of current taxes. Because by relevant tax law, you'll be allowed to utilize tax losses previous years in the current period before you can be assessed to tax. Therefore, giving rise to reduced taxes in the future period. Therefore, what do? You add the tax rates multiplied by unutilized tax losses, not accounting losses, that is allowed to be carried forward. Why the emphasis on tax losses? Because tax losses are losses acceptable for tax purposes. Accounting profits might not be accessible on the basis that when certain adjustments have been made, such accounting loss may no longer exist as a loss for tax purposes. It doesn't stop here also. It went further to realize that we might have situations where capital allowances are not utilized in full in prior periods. And what does that give rise to? That gives rise to you carrying it forward to enjoy lower taxes in the future periods. And therefore, we also multiply it, the tax rates, with the unutilized tax credits allowed to be carried forward. It is the sum of these three items, if any, that gives recognition of deferred tax assets. And that's how we determine that. Any question before I proceed? Any question before I proceed? You can send question on the chat, and you can equally send question by raise up of hand so that I can allow you to unmute. Any question? I've not seen any answer. If there's no question, that means I should assume all is well. Okay. Now let me proceed. Now, I explained what temporal difference and what deductible is. I can also explain it logically or mathematically by this expression. Okay, now look at this expression. There are two factors that we have to consider in determining our deferred tax position, whether it emanated from taxable temporal difference or deductible temporal difference. Now, remember, we said temporal difference are differences between the carrying amounts and the tax base of assets and liabilities. Therefore, we'll come here, we'll say we have assets and we have liabilities. We also come here to say the difference attributable to asset or liability is between carrying amount and the tax base. The carrying amounts can be higher than the tax base, and the carrying amount can be lesser than the tax base. The question then is, it depends on the position that will determine whether it is taxable or it is deductible. Let's start by this. If you are dealing with an asset, whether PPE, inventory, receivable, investment, and the rest, and the carrying amount of such an asset is greater than the tax base, the resulting difference for assets will be taxable temporary what? Difference. Otherwise, if you are dealing with a liability such as your loan, your payables, and etc., your deductible, your carrying amount, if it's greater than the taxes for liability, it will give you opposing direction, which is deductible temporary difference. When we flip it over and say, okay, the carrying amount is no longer higher, but it's less than the tax base. If you go back to an asset, you find out that for an asset where the carrying amount is less than the tax base, the result it will give you is deductible temporary difference, which is opposing direction of when it is greater. Similarly, when you get to the liability side, and the carrying amount in this case is less than the tax base, it will give you the opposing direction, which gives you the taxable temporary what? Difference. Which means if you, by way, you can't recall from a descriptive perspective how you determine whether temporary difference is taxable or deductible, you can use this matrix in determining it based on what I've just explained. Any question? Any question? Okay, if there's no question, I'll move further. Okay, now let's go back to those questions we are trying to answer. Where's my notes? Okay, I've seen it. Now let's come back here. We've answered the first question, what temporary difference is. We've identified when it is taxable and deductible, and we've identified or we've determined how we ascertain the amount of deferred tax liability and the amount of deferred tax assets. The next question is, what is the relevant tax rate? Now, what is tax rate? It is a portion of profits, gains, or any reference points to which government wanted to take its own share of. What does that mean? Let me use profit as a common factor. If an entity makes profits of 10,000 naira, government will say, okay, from the law, based on the fact that government provides an enabling environment, rightly or wrongly, what portion of the profit will be good enough for the government to take in order to fund its activities, its social welfare and all other things. And the Nigerian law came to a conclusion to say, okay, for companies that are considered big, it is 30%. Therefore, that 30% of that 10,000 is what determines the amount of taxes you pay. Which then means that apart from the reference point, which is a profit, the rate given in order to determine the share of government. It's what we call the tax rates. Now, these rates can take different forms based on regimes and based on changes in tax laws. And I'll say the tax rates can be viewed from two perspectives. Perspective of the mode of recovery. Or settlement. What does that mean? Of assets and what? Liabilities. Now, let's speak it from the perspective of assets. There are two mediums to which the benefit associated with an asset can be enjoyed by an enterprise. The first way is that you can enjoy the benefit or economic benefit associated with an asset when you make use of the assets. Otherwise, you can accelerate the benefits when you dispose of the assets, which means either through use or through what? Disposal. Now let's talk of true use. True use means the asset will generate revenue, which you match with the cost and arrive at taxable profits, which by Nigerian law, such profit will be taxed at what rate? 30%. But if that same asset, you decide to sell it off and make capital gain from it, in Nigeria, it won't be taxed as true use. Rather, it will be taxed through capital gain at what? 10%. Which means the rate I will use is dependent on the fact that by the nature of the resources employed, will I use it to generate revenue or I'll use it to generate other gains? If I use it to generate revenue, the rate I will use in applying the deferred tax principle on that asset will be 30% in Nigeria. Whereas if it's going to be through disposal, which will be subjected to capital gain tax by Nigerian tax law, I will subject it to 10%, which means this will influence which rate is applicable at any point in time. The other thing I need to take note of is the nature, or let me say the statutes and changes. The word statute means law. Changes means changes to that law. Now, there are two things I have to consider here. I have to consider, am I to apply the enacted tax rates or am I to apply the substantively enacted tax rates? What is the difference? And this is with reference to 30 and 10. Enacted tax rates, in principle, is the prevailing or ruling tax rates, which is what is in force. Today, pending when Finance Act of 2021 will be released to the National Assembly and the public for deliberation and immediate passing into law and awaiting presidential assent, The ruling tax rate for any company to pay tax, except for small companies or medium-sized company, is 30%. And that is the enacted tax rate as Nigeria is concerned today. But a substantive tax rate, substantively enacted tax rates, in principle, are tax rates not yet in force. What it means is that this is the tax rate that is still being deliberated upon, or that has been enacted but has not yet become effective. Which means if the National Assembly, by way of Finance Bill of 2021, passes the new bill, which will become Finance Act of 2022, or 2020 as the case, 2021 as the case may be, you will find out that such a rate will not take effect until when the Act stipulates it to take effect. Which means if today they change Nigerian tax rate to 40% or to 25%, and we are told that it will take effect from 2022 year of assessment. In 2021, as we are today, we have two tax rates. We have 30% and we have 40%. 30% will be the enacted tax rate because that is still what is prevalent. That is still what is in force. While 40%, which is a new tax rate, is what we characterize as substantively enacted tax rates. Why? Because such a rate will only come to force at a future date, even though it may have been enacted or it is in the process of being enacted. Does that make sense? I want people to ask questions because this will play a role in what we are going to do forthwith. Any question? Any question at this point? Okay, if there's no question, let's now go back to our presentation material and let's talk a little about tax base. Why are we talking a little about tax base? Is because kind amount is what we chill on a daily basis from our understanding of every standard that applies to different categories or class of assets and liabilities. Now, what is a tax base? What is a tax base? For short, as I've said earlier, a tax base is simply the amount that you recognize an asset or a liability for when it comes to tax assessment or tax administration, which means it is the amount of an asset or liability for tax purposes. That's what we call a tax base in its general concept. But let's not go granular and pick it one by one and define it with respect to assets and with respect to liability. When we talk about tax base for an asset, what are we talking about? We are simply talking about the amount that you are going to recognize that asset for tax purposes as determined by the amount recoverable from the cost of that asset, which will be enjoyed for tax deduction at a future date. And that's why here I summarize it as follows. I said, the tax base of an asset is usually equal to the amount that will be deductible for tax purposes against any taxable economic benefit that will flow to an entity when it recovers the carrying amount of that asset. Now, let me break it down. If you have an asset of PPE, the tax base of that asset, as at the time you purchase it, will be equal to the cost of that asset if the entire cost of that asset is admissible for tax purposes. But as time goes on, if you have enjoyed capital allowance from that asset, let's say you enjoy capital allowance of 2,000 from an asset of 10,000, what is left to be enjoyed as capital allowance over the remaining life of the asset is the difference between 10,000 and 2,000, which is 8,000. And that will be the tax base as at that period. Now, what is the consequence of this definition? Is that one, where the economic benefits associated with an asset will have no tax consequence. In that situation, there's no temporary difference value to that asset. That implies that the carrying amount of that asset and the tax base will be the same. And they will only be the same on the premise that we equate whatever the tax base is to what the carrying amount is. Which means in that light, the tax rate will always be determined with reference to what is the carrying amount. Another perspective is this. Where an asset has no tax consequence, the tax base of such an asset will always be zero. And that is the deferred tax consequence of such an asset will always be what? Is zero. Now, let's look at some practical examples. Now, a plant that costs 20,000 naira for tax purposes, depreciation of 5,000 has already been deducted. And here we are talking of, for tax purposes, depreciation is known as capital allowance or tax depreciation. And we are told that the remaining costs will be deductible in the future, either by way of tax depreciation, which is capital allowance, through a deduction or through a deduction on disposal. Revenue so generated and associated with this plant will be subjected to tax. Equally, the gain on disposal of this asset will also be subjected to tax. And any loss will be relieved for tax purposes. The question then is, what will be our tax base? It will be simply the difference between the cost of that asset and the accumulated capital allowance that has been deducted up to date. And in this case, we have only deducted 5,000 by way of capital allowance from 20,000, and that will give us 15,000. Given that also that the asset we are talking about, the revenue associated with it will be subjected to tax. Another one is to talk about interest receivable. What are interest receivables? These are receivables arising from recognition or accruing for interest income from probably the loan you give to a third party. Therefore, you accrue interest, and that interest goes into your profit or loss as an income and goes into your balance sheet as a receivable. I will say we have interest receivable of 3,000. And we are told that for tax purposes, the interest revenue will only be taxed on cash basis. What does that mean? It means though we have recognized income of 3,000 in our books for profit purposes, but for tax purposes, such will not be allowed as taxable income because such income has not yet been received in cash. You now ask me, how do I know it has not been received in cash? It's because for you to have a receivable, it means it's still outstanding. That means that in that case, the tax base of such a receivable is zero because such receivable is not recognized for tax purposes until the actual cash has been received before such an income will be subjected to tax. In that light, the tax base of a trade receivable of interest receivable that is subjected to tax on a cash basis will be 0. Now let's look at another example. Trade receivable had a kind amount of 25,000 naira. When you hear trade receivable, it means you have either rendered a service or you have sold a good and you have recognized such revenue for you to recognize a trade receivable. Now, from the angle of the tax law, what did they say? They said the tax law is such that the revenue that have been recognized from this trade receivable are already included in our taxable profits. What it signifies is that for tax purposes, the revenue is subjected to tax regardless of whether you have received it in cash or not. And that is what this signifies, which shows that there's no difference between the recognition of revenue for tax purposes and for accounting purposes. Therefore, there is no difference attributable to such. And for there not to be difference, it means the kind amount and the tax base are the same. And what will be the tax base now must be equal to what the kind amount is, which is 25,000 naira. The other aspect, which is example 4, is to have loan receivable with a kind amount of 10 million. When you talk about loan receivable, what it means is that you gave loan out to someone and the loan has not yet been repaid. Now we are told that whenever this loan is repaid, it has no tax consequence because they are only repaying you your principal. The question then is, what will be the tax base? Since there's no tax consequence on an asset, it then means there's no temporary difference. At all points in time where there's no temporary difference, the tax base of an asset will equal to the kind amount. And that's why here we said the tax base is 10 million naira. Likewise, we have another illustration here that says we have dividend receivable from a subsidiary. Dividend receivable from a subsidiary is an asset to the tune of 50,000 naira because we have recognized as income, but we are yet to collect it in cash. Therefore, it's an asset to us. The dividends are not taxable. Where dividend is not taxable, it means there's no tax consequence on it. And as I have said, whenever there's no tax consequence on an asset, it means there is no temporary difference to give rise to. And for there not to be temporary difference, it means the kind amount and the tax base are in alignment. And to now determine the tax base, we'll determine it with reference to what the kind amount of the dividend receivable is, which is 50,000. Now, let's now look at the perspective of a liability. The perspective of a liability is slightly different from the perspective of an asset. At every point in determining the tax base of a liability, the reference point will always be the kind amount of that liability, subject to an adjustment, if any. What do I mean? At any point in time, the tax base of a liability will be the kind amount of that liability less any amount that will have been deducted for tax purposes with respect to that liability in a future period. What it simply means is this. Let me share my notes. What it means is this. The kind amounts the tax base of a liability is the kind amount of the liability, let me say 10,000, less the tax deductibility of liability. In this case, let me say 500. Therefore, this is the tax base of a liability. Now, which is 95. Now, in the example we are going to look at, we'll try to look at the tax base of the following liabilities. I think there are 5 in all. The carrying amount less amount deductible. Okay. Now, let's go back to the question one by one. I want somebody to read the first question. Okay, before reading the first question, I'll give you the consequence. Where revenue is received in advance, the tax base of the resulting liability is the carrying amount less any amount of that revenue that will not be deducted in the future period. We'll see that in this question. Also, where liability has no tax consequence, the tax base of such liability will always be equal to the carrying amount, which gives our temporary difference to be 0. Now, let's look at this. Who would volunteer to read so that I'll give you access to read? So that as you read the question, don't read the answer. I'm going to, okay, Olua, okay, you have access to read the 5 questions without reading the answer along. Read the 5 questions.
Question 1. Current liabilities include accrued expenses with a carrying amount of 12,000 naira. The related expenses will be deducted for tax purposes on a cash basis. Question 2. Current liabilities include interest revenue received in advance with carrying amount of 14,000 naira. The related interest revenue was taxed on a cash basis. Question 3. Current liabilities include accrued expenses with a carrying amount of 1,000 naira. The related expenses has already been deducted for tax purposes. Question 4. Current liabilities include accrued fines and penalties with a carrying amount of 5,000 naira. Fines and penalties are not deductible for tax purposes. Question 5. A loan payable has a carrying amount of 13 million naira. The repayment of the loan will have no tax consequences.
Thank you, Oluwatosin. Okay, let's pick it one by one. The first one was accrued expenses as a liability. The accrued expenses carrying amount is 12,000. And we are told that the related expense will be deducted for tax purposes on cash basis. Now, let me switch to my answer, to my whiteboard. Now, I'll describe accrued expense. Is that my liability? Remember, accrual. Now, the accrued expense is 12,000 naira. What is an accrued expense? It means you have incurred an expense, but you have not been invoiced. Which means even if you have not been invoiced, to close your books for the year or for the period, you must recognize that expense, because expense is recognized as being incurred, not when it was paid for. Therefore, what will I do? I'll debit my expense, which reduces my profit, and I'll credit my liability, which is my accrual, with 12,000 naira. But for tax purposes, they said this expense from the question, let me go back to the question. They said this expense will only be deducted for tax purposes on a cash basis. What it means is that this expense is not allowed by the tax law in this case unless it has been paid for, which means the tax authority will disallow it and allow it in the future when you pay for it, which means in the future is when we accept that deduction. And if that is the case, what you deduct in the future, amount deductible in the future, is what? 12,000. Therefore, what is the tax base? Is 0. That is how we arrive at the tax base of nil in the presentation slide. Now let's look at the second one. The second one said we have interest revenue received in advance. When you receive interest in advance, it's a liability to you. What does that mean? I gave you a loan as an entity, but before interest is due, you have already deposited interest to me. I can't take it as income. As I receive the cash, I debit it to my bank. I will not credit profit or loss because I've not earned it. I'll credit my liability. And that is what gives rise to interest income, interest received in what? Advance as a liability. Now, from the angle of the tax law, the revenue will tax any interest you have received. They don't know about accrual, like you incurred it or you've earned it or not. The only is that you give somebody loan and the person has already given you interest in advance. Therefore, subject it to tax what? Immediately before the money disappears. Therefore, from the angle of the tax law now, it says that the interest revenue will be recognized on a cash basis. That is when the cash has been received. Which then means that this year they will have subjected you to tax, even though you have not recognized this for accounting purposes. Which then means that such an interest received in advance, which is a liability, of how much? Let me check. How much is it? Of 14,000. That's kind of much. Now, the question is this. If you have already taxed what I've received, but it's not yet income in my hand today, next year, for accounting purpose, where I now recognize this as income, will it be subject to tax again? No. It is such will be deducted from my taxable profits because it has been subjected to tax earlier last year, and such will not be subjected to tax the second time. And that's why such income will be classified as non-taxable what? Income. And if you go back to this stuff we did the last time, you see one of those things we mentioned here. Non-taxable income may include what? Income that falls under different, yes, income that have suffered tax in advance. And such tax, for example, withholding tax or whatever, consider the final what? Tax. Do you get what I'm saying now? Such income will be what? Exempted from tax in the current what? Period. And that is that. Therefore, in that case, I come back here and say, you will allow me to deduct the 14,000 from my taxable profit in the year I recognize that as income, because the Bible says affliction shall not rise the second time. You've deducted it earlier when I've not recognized as income for tax purposes. You've taken it for tax purposes earlier when I've not earned it. Now I'm earning it, you can't take it the second time. And it means my tax base is what? Is nil. And that is what gave us the position of nil we have here. Okay, the third one says we have accrued expenses again. But unlike the first case, the accrued expenses in this case has already been deducted for tax purposes, which means the tax law in this perspective or in this situation allows for deduction of expenses once it has been incurred, not until when it has been what? Paid. Which then means that such an expense of 1,000 naira in this regard, accrued expense, ₦1,000 have been deducted already, which means in the future period, you have nothing to deduct against the liability. And that gives us what? 1,000 as a tax base. Therefore, you should check this against this and see where the difference lies. Okay, now let's look at the fourth example. We have accrued fines and penalties with a kind amount of 5,000. But we are told that fines and penalties are not deductible for tax purposes. What does that mean? What it means is that there's no tax consequence on the liability. Let me put it here. Accrued fines and what? Penalty. If there's no tax consequence on any amount or any liability, it means the tax base and the kind amount will be the same. How much is that? 5,000. Why are they the same? Because there's no tax consequence. What it means by there's no tax consequence is that, for example, whenever you pay fines and penalty, Nigerian tax law will not allow it for tax deduction. Not because they want to allow it in future. They will never allow it whether today, tomorrow, or in the future. Or because such is deemed not to be only reasonably, exclusively, and necessarily incurred in kind of the business, which means such will never give rise to any difference at all. And in that case, such a difference is considered permanent difference. And to recognize that, it means since there is no difference in it, no deduction against the future, your tax base will be the same as the carrying was amount. Now, lastly, let's look at the last one. The last one here says loan payable to the tune of 30 million. What it means is that we are the one owing someone. They borrow us money, and we are told that when we repay the money, there is no tax consequence. Again, it speaks to the fact that there's no tax consequence on the premise because when I pay that loan, there's nothing to be enjoyed by way of deduction, except for the interest on the loan, which will have been captured separately, loan payable. The principal amount of the loan, which is 13 million, has no tax consequence. Therefore, the tax base and the carrying amount will be what? Will be the same. And that brings us to the understanding of how to determine the tax base of an asset or liability. Now, let me try and get the practice question that I think we shared, and I want you to look at it from your side and try to solve. I'll give you as a class exercise. Can somebody reshare that practice question? Okay, I'll search for it. Has anyone tried to reshare the party's question? Okay, let me copy and paste something for you guys. Okay, I think I have something here. Let me share the screen. And I want you guys to attempt it in just 5 minutes. And let me see your answers. Just question 6P. What is the tax base of the following transactions, asset and liabilities scheduled below?
Okay, I think
Sorry, I didn't get yourself. What did you say?
okay, you have to take us through the whole of the answer according to what you guys have agreed upon.
Oh,
Okay.
okay.
Can you read the question out from the information here? What is the tax base for the following transactions, asset and liability scheduled below? Take us through the questions one by one and how you guys are able to arrive at this answer. Thank you.
Okay. So, what is the tax base for the following transaction? In brackets, asset and liability scheduled below. Number one, a plant costs 20,000 naira for tax purposes. Depreciation of 5,000 has already been deducted in the current and prior periods, and the remaining cost will be deductible in future periods, either as depreciation of through a deduction on disposal. Revenue generated by using the plant is taxable. Any gain on disposal of the plant will be taxable, and any loss on disposal will be deductible for tax purposes. We have a tax base of 15,000 naira because we've deducted the 5,000 naira of depreciation from the plant cost, which is 20,000 naira. So our tax base will remain 15,000 naira. Number two, interest receivable as a carrying amount of 3,000 naira. The related interest
Before the
revenue
number two, sorry, before
Oh, okay.
Hello, can you hear me?
Yeah,
Before
I can hear you,
number
sir.
2, I want you to emphasize. Yeah, the depreciation you are talking about, is it tax depreciation or accounting depreciation?
I think it's tax depreciation because
Yes,
here in the
it's tax
question
depreciation because it's for tax purposes.
purposes, yeah.
It's for tax purposes. If you don't see tax depreciation, you can also see capital allowance. And that's what it is. Thank you. Can you move to number 2?
Okay, question 2. Interest receivable as a carrying amount of 3,000 naira. The related interest revenue will be taxed on a cash basis. They said since the amount, the tax base is 0, that's nil. The interest received as a carrying amount of 3,000 naira. It has not been received as, sorry, it has not been, it has been taxed. The amount deductible is 3,000 naira. So the tax base is nil, that's 0.
Okay, continue.
Question 3. Trade receivables have a carrying amount of 25,000 naira. The related revenue has already been included in taxable profit. Our amount deductible will be 0. Since it has already been deductible already, so we can't be deducting it again. So we have a tax base of 25,000 naira.
Continue.
Okay, sir. Question 4. A loan receivable has a carrying amount of 10 million naira. The repayment of the loan will have no tax consequence, and the tax base is 10 million naira. Since the loan itself, that's the principal amount of the loan, is 10 million naira, the tax has no tax consequence, so there will not be any amount deductible. So we'll still have the same tax base of 10 million naira.
Okay.
Question 5. Current liabilities include accrued expenses with a carrying amount of 12,000 naira. The related expenses will be deducted for tax purposes on a cash basis, and the tax base is 0 or nil. Accrued expenses is 12,000 naira, which is the carrying amount. Then they said it has to be deducted for tax purposes on cash basis. So we are going to deduct the same 12,000 naira as our amount deductible, and we have the tax base of 0.
Okay, continue.
Okay, question 6. Current liability includes interest revenue received in advance with carrying amount of 14,000 naira. The related interest revenue was taxed on a cash basis, and the tax base itself is 0 or nil. To get the tax base, it has always been stated in question that the interest revenue received in advance was 14,000 naira, and it must be taxed on a cash basis. So the amount deductible will be 14,000 naira, and we'll have the tax base of 0.
Okay, continue.
Okay, question 7. Current liabilities include accrued expenses with a carrying amount of 1,000 naira. The related expenses have already been deducted for tax purposes, and the tax base is 1,000 naira. Why we're having 1,000 is because it said it has already been deducted for tax purpose. So the amount deductible will be 0, and the tax base will still be 1,000 naira.
Okay.
Then question 8. Current
Final one.
liabilities include accrued fines and penalties with a carrying amount of 5,000 naira. Fines and penalties are not deductible for tax purposes. The tax base is 5,000 naira. Since the fines and penalties are not deductible for tax purposes, our amount deductible will be 0, and we still have tax base of 5,000 naira, which is equal to our carrying amount. Thank you.
Thank you very much for that sound and brilliant contribution. Okay, thank you very much. Let's move to the part we are going to wrap up with before in the next gathering. Probably it might be on Thursday. We might have evening class on Thursday where we'll continue from where we stopped. Okay, but let me just give these snippets for you guys to play with as we move on. And okay, this is a summary of what we have done today. Between where we started and today, this is a summary. Okay, can you see it? Okay. Now, what you can see here shows the whole impact of presentation of current and deferred taxes in our financial statements, that is IFRS compliant. Current tax, as we arrive at it, as the amount payable or refundable by the tax authority in respect of current and previous periods. These are reported in different sections within the financial statements as it relates to the transactions that gave rise to them. And what you can see here is that it could be reported in profit or loss. It could be reported through other comprehensive income. Some are reported directly in equity, usually attributable to business combination and the rest. And various steps you need to take in recognizing this have been discussed. Also, deferred tax, we said we need to determine the carrying amount of an asset and the tax rate of an asset, and the difference between the two give us our temporary difference of the assets. Similar to that, we do that for liability also. Our temporary difference could be taxable, could be deductible. If it is taxable, we multiply by the tax rate, it will give us deferred tax liability. If it's deductible, we multiply by the tax rate, it will give us deferred tax assets. Okay, but in addition to computing for assets, there's also additional recognition of deferred tax assets arising from unutilized tax losses and unutilized tax credits that are carried forward. And that will also give us to deferred tax assets. Now, also, the steps you follow in recognizing deferred tax assets, being the future tax consequences of recovery or settling the carrying amount of an asset of liabilities, follows these 5 steps. The first step is that since you know your carrying amount, you also need to determine your tax base. Therefore, you determine the tax base of assets and liabilities, each asset and liabilities, which is what we have demonstrated just now. You compare the tax base of assets and liabilities with carrying amount of assets and liabilities, you arrive at the temporary difference. Okay? Having arrived at temporary difference, you recognize deferred tax on them by applying the appropriate tax rates, subject to limitation with respect to the exceptions in the recognition criteria. We are going to get to the exceptions later, probably in the next class. Step 4 is that to calculate deferred tax using the appropriate tax rates, which is a function of usage or function of sales, which means usage means once you are going to deploy it in the course of the business, you apply 30%, which is Nigerian tax rate. If it's going to be attractive for disposal, other than the ordinary cost of the business, you apply 10%, which is the CGT, capital gain tax rate. Okay, and you recognize net movement in your deferred tax asset and liabilities as what impacts your income taxes, which is the adjustment you make to your current tax, you arrive at your income tax before presenting your taxes within your financial statements. We also went further that deferred tax emanated from temporary difference, which could be taxable or deductible. And taxable or deductible temporary difference arose from differences in tax basis and carrying amount. Having applied appropriate rates, you have your deferred tax assets and liabilities. And we showed you a logical table or matrix where you can determine whether it's taxable or it's deductible, or whether, okay, let me enlarge it if possible. Okay, which is what you can see on the screen now. Okay, I believe you are seeing it now. I've enlarged it so that I can see clearly. Okay, now the nature of the tax rates by status will determine what to use. Is it enacted or substantively enacted, as I've explained earlier? Okay, now another thing I want us to have better appreciation of is this. Okay, let me enlarge this. Okay, to what extent are we going to recognize deferred tax? There are three schools of thought. Some say we don't need to make provision for the recognition of deferred tax. Some school of thought says we need to only make provision on certain assets or liabilities. And why another school of thought says you make provision on all temporary differences. Okay, now what we go with is a full provision from the perspective of IAS 12, which means at no point in time will you not recognize deferred tax consequences on all assets and liabilities as you have it in relations with the entity. Okay, which means full provision is what we are going to recognize. And that's why you are going to compute deferred tax on all assets and liabilities, subject to the exceptions as we are going to discuss in the next class. Secondly, you don't discount in the process of computing deferred tax, which means in arriving at our tax base or in determining our temporary differences, discounting is not taken into consideration, even though we are dealing with the future. And the essence of this is in two folds. One, the complexities discounting will introduce will not be suitable for accounting purposes. And it might become onerous, where the cost of complying or meeting such requirements might outweigh the benefit. Secondly, it might also tantamount to double discounting because in the recognition of some kind of amount, those values may have been discounted in obtaining their kind amount, especially for those assets and liabilities of which the measurement basis is present value. And therefore, on that premise, discounting is not permitted under IAS 12. You might come with a case or scenario where they will argue that there should be or shouldn't be discounting. It's for you to answer the question by making reference to the position and the reason why such is not permitted by the International Accounting Standard Board with respect to computation of deferred tax. And now it's with reference to deferred tax. But with current taxes, it may be allowed if those taxes will be paid for more than one accounting period, but which usually is not the case. That's why you barely also see discounting when it comes to current taxes, because in most jurisdictions, current taxes are paid not later than 6 to 12 months of the year in which that assessment has been made. Like in Nigeria, if your year end is 31st December 2020, you are expected to have paid your taxes not later than 30th of June 2021, which means 6 months after your year end. And therefore, discounting will no longer be effective because of the timing and because of the difference is not up to 1 year or more. And that is the position there. And I think when we come to the next section or next class, we'll look at other areas such as effect of changes in tax rate and everything, where we have done some assessment by way of computation. Next class, we are going to go deep with this understanding to compute deferred taxes on some questions. What I will advise you is that you go on to the practice question and you solve the following questions that may have arisen. Now, I'll give you the following questions to go and attempt. Question 4, go and attempt question 4, go and attempt question 7, attempt question 8, attempt question 9, attempt question 10, attempt question 11, and question 12. These are the things we'll play with in the next class. Okay. Any other question, contribution before we call it a day? By show of hands or by commentary? And I think what I can do at this point is to give all of you access to a mute. If you want to talk, you can mute directly and make contribution or ask the final question before we call it a day. Thank you very much. Any question? Okay, in the absence of none, thank you all for your contribution. And we'll continue our discussion on the WhatsApp group on when next we'll have the class. Thanks, and God bless you all.